What's going on, everyone? This is Jordan with Conquer Trading and Investing, and we're getting ready here to look at the S&P 500. Notice you're not looking at the SPY, you're actually looking at the S&P 500 here in this video. We have a lot to go over, including we're going to take a look at the VIX. We're going to take a look at what happened with the Bank of Japan. We're going to take a look at what's going on with the US dollar, and we're also going to take a look at what the upcoming FAANG earnings might mean this week. So we have a full video ahead of us. We're going to start it off with taking a look here at the S&P 500, and you can see that we've come up today into the strong resistance we have over at 28.92. You could see that it was tested so far this session. It is very strong resistance. It's also a particular point in the charts where if price is able to get above here, at that point we really need to begin having a bullish bias. Right now, definitely that bias is bearish, and that's ever since we've had the break of this rising wedge pattern. And right now, after that break, we're coming up and we're testing heavy, strong resistance, looking for a resumption down, unless we do wind up breaking above, at which point we're going to start looking for some longs right now. Now, there's a lot more to add. First, I want to point out this yellow trend line over here. Some of you have asked, what exactly is that, Jordan? Why do you have that on your chart? This was going back to over here when we had this meltdown, right? And so what I did when we had this meltdown, I was trying, as you're in this free fall, to try to put onto the chart some possible area that the chart may actually come into some type of resistance on the upside. I went ahead and I added this trend line connecting these two main points, and then you could see actually that over here price did wind up even touching those and stalling out there. Now at the same time, you could see where this resistance is. You could see that's also, this was support that didn't hold. So at the same time, that could have been horizontal local resistance that held, but as far as I know, it was also this trend line. So I kept it on my chart to see what would happen as we got towards over here. It held again. Again, you're looking at horizontal resistance. And listen, just so you know, horizontal resistance always carries horizontal support or resistance. Horizontal lines always carry more weight than trend lines. Now let's go look at what happened intraday today, and you could see a couple of things. We could see that, first of all, why this trend line looked like it might have been in play. It's hard to tell, again, whether or not that's just some resistance being put up or it was the trend line. I'm going to keep it on the chart a little while longer just to see how that continues to play out. But let's focus in right now on what happened. You could see earlier in the day we broke above the 28.52 resistance. We broke above it and then came back. We did test that one time and it held as local support. Now, I have to tell you, and we're going to flip back to that into a second, we'll look at the daily chart, because you need a support and a resistance line to hold on the daily time frame to consider it a break or a hold. So intraday though, this was holding, right? This was holding, flipped that support, price came up, it couldn't break above the local resistance. It tested again this area which held that support, and then we had a slow rise up into the resistance above us. 28.92 is where I have it. We came right into the resistance area. That's where we are right now. We're going to take a look at what we do from here and how we're going to trade this. First, let's look at a couple of different charts that are very important for us to be aware of. The first is, this is a chart of the VIX. Now, you could see over here, you have the gap on the VIX that was closed. You could see that coincides with the bottom line of a channel. You could see that trend line over here. Now, some people, and one of the comments was here was, technical analysis does not work on the VIX, right? And then the response was, Sven from northmantrader.com. If you're not following northmantrader.com from time to time, post some really interesting charts, was definitely one of the people sounding the alarm as the equity markets were at all-time highs. I really do enjoy lots of the charts shared. He is saying that, no, listen, he has posted in the past technical analysis on the VIX, and it has been giving us a heads up. Right or wrong is not the discussion for this time. It's just something to be aware of. More importantly, and we're coming across into a critical area of strong resistance, right? Not just here on the S&P 500, but across the board in a lot of equity individual pairs and across all the indices, as the VIX is hitting down, closed the gap, and is on some lower possible trendline support. Here you have all these instruments also at this really crucial area. Something that I wanted to share with you that is big news that we all should be aware of. We need to be, we looked at this on over the weekend about liquidity. As Stanley Druckenmiller was saying, you have to follow the liquidity. And here we're seeing that Bank of Japan has gone in with unlimited bond buying. All right. Now, they did this at a time when the government will be issuing new bonds to fund fresh stimulus. If you look over here in the white, you could see that this is a percentage of the Central Bank of Japan's balance sheet as a percentage of their GDP. Now, they're up all the way to 111. The Swiss National Bank is up to 122. Come back down to the Federal Reserve in blue. Look at this $4 trillion addition leading the way to the upside, only at 30% of GDP. Now, we're expecting the second quarter GDP. Over the wires this morning out of the White House, they're saying that the second quarter GDP could be negative 30%. So we'll see where that takes this, right? All of a sudden that might be a little bit higher. But the point of looking at this, first of all, is twofold. First, I want you to see that the U.S. actually has room to expand their balance sheet a lot further before we reach the heights of the Swiss National Bank or the Bank of Japan. Second is look at the amount of expansion of the balance sheets that we've seen over the past several weeks. Now, I do want to get into this. This is very important. This is on the U.S. dollar. We're going to take a look here. We're going to look at both sides from time to time, the bullish case, the bearish case. When it comes to the S&P in general, we're always considering both the bear case, the bull case, the neutral case. Here we need to look at the bullish case of the US dollar. Now, a lot of traders right now are seeing all of the expansion of the balance sheet by the Fed. They're saying that this is going to have an effect on the dollar. You could only print so many dollars before you start seeing the dollar weakening. Normally, it's about 60 days lag until you see an effect on the dollar, okay? That's number one. I am definitely more cautious because of the amount of the expansion of the balance sheet. I am looking out for the possibility of the dollar weakening. At the same time, I'm still holding on to my bullish bias. I will continue to walk you through that as it unfolds. I do want to take a look at this tweet thread from Raul Pal, the founder of Real Vision. Raul has been right on top of the macro for the past 12 months. It's worth paying attention to. Let's take a look at this before we take a look at what's next on the S&P 500. Now, Raul starts this off with calling this the dollar wrecking ball. Now, his thesis is that what is going to happen is we're going to see ultimately a very, very strong dollar, which is actually going to cause havoc on the whole financial system, ultimately ending in a devalued, weaker dollar, but not until it causes a lot of damage. Now, he says he hears their narratives that the Fed is printing money, the printing presses go brrr, and that is going to cause a dollar collapse. I worry that this narrative is very wrong. My strongly held view is that the dollar is in the pinnacle of the macro issue we face. The Fed has undertaken unprecedented printing, as we know, and the balance sheet is growing exponentially. We looked over here that this could go from roughly where it is now, $6.5–7 trillion, up to $20 trillion. And still be in line with what is happening. Nevertheless, look at what is happening. This is the 2008 financial crisis. You could see after a decade, they started tapering. And as soon as they started tapering, what happened? It caused a dollar shortage. And look what the response has been. We're up to $6.5 trillion. He says it's not that simple, though. We live in a relative world where the dollar standard is the very cause of many of the issues we now face. There is simply not enough dollars available in the world to service all the debts plus interest, and thus a debt deflation remains the big risk. Now, we are seeing a deflationary type environment right now. What just happened to the price of oil? It went negative, right? The expansion of the balance sheet is the fact correlated. The expansion of the balance sheet is in fact correlated to the rise of the dollar, not the fall. Here is the Fed broad trade weighted dollar index versus the Fed balance sheet, and you could see the size of the Fed's balance sheet almost mirrors the Fed broad trade weighted dollar. Now, he says, since last year when the global slowdown started, the two are joined at the hip. People have been looking at the messy chart of the DXY and have been quick to call the end of the dollar rally. But to me, the DXY broke a small wedge pattern. Now, you've noticed we've also, in our live streams, for the 9 o'clock a.m. live streams, have been following this pattern as well. I also have been pointing out that we have broken to the upside, and I currently have a bullish bias, actually, until we take out first 99.80 and then 98.35 for me to turn bearish near term on the dollar. This is quite bullish. He says a break of 103 on the DXY over here would be a break of a neckline of a large cup and handle pattern. You could see over here the cup and now the handle, and this is the neckline above 103. That was the high that was put in earlier this year. He said, which in turn would lead to an acceleration phase of the bigger downward sloping wedge break that I've been following most of the last decade. Here it is. And what he's saying is if we break 103 up here out of the cup and handle, that is then resetting us up over here for a further leg up outside of this wedge breakout. The Fed trade weighted dollar index is even more concerning, is already broken out of a massive cup and handle and is at all-time highs and appears to be accelerating. And this is without the RMB moving much. Operative word, yet. The magnitude of this pattern is mind-blowing. Here is the long-term chart going back to the 1960s. This is matched by the size of the top pattern in the Asian currency index, which is so big that it's almost beyond comprehension. You see all these things lining up. Right now, we see that everyone is very bearish the dollar simply because the print and press has started. Now look at these charts. Look at everything that Raul is putting together the case for. You could see at the same time the world is short $4 trillion, meaning they need those dollars to pay back debt and the interest on that debt. Normally they get those dollars through trade because of the situation in the global slowdown right now, because of almost the many countries on lockdown. There simply is a stalled economy. There is no trade going on. Therefore, people aren't getting dollars. A lot of countries' dollars come from the sale of oil. The demand is not there. Plus, you're seeing the price of oil so low. This all has an effect. He said the short-term chart of the ADXY, this is the Asian dollar index, looks like it's about to break lower again. And it's not just in Asia. The entire emerging market is in a complex free fall. If you look at what's happening over in Brazil, if you look what's happening in South Africa, Mexico, you're just seeing the free fall that we are currently in versus the dollar. So this brings us back to the velocity of the money that the Fed is printing. It is plummeting, and that is crowding out the weakest borrowers. It is the case of emerging markets FX. This is the very essence of debt deflation. He made a pretty strong case here. You have to pay attention. Just don't jump onto the narrative that we're going to see a weaker dollar because the Fed is printing. This year alone has been a bloodbath of currencies versus the US dollar. Look at the Brazilian real. We just talked about the South African rand and the Mexican peso. And just look at the damage it's done across the board. And since the Fed started printing, he makes a joke about the meme, the money printer goes brr. The situation has gotten no better. This is since the Fed has started printing. Look at this. All right. So you see the biggest problem the world faces is the dollar. We are in a vicious doom loop where slowing growth causes the dollar to rise, which causes slower growth, which causes the dollar to rise, as all borrowers play musical chairs to get access to the dollars to service their debts. They have to pay back their debt based in dollars and with interest. Dollar swap lines, QE, jawboning have done nothing to stop this. Nothing. The issue here is that swap lines can help the weakest sovereign borrowers as they have no reserves, and the $13 trillion short is held mainly by corporations which struggle to get access to those dollars. Due to the fact that they are suffering massive weakened cash flows, there's no trade, from trade tariffs, collapsing commodity prices, oil, think of it, slowing world growth, and a shrinking U.S. trade deficit, tariffs, oil, and slow growth, the global system is just not set up to deal with this. It's an ugly situation with almost zero options without a change in the entire system. No printing of money will solve this. It is structural. Now he gets into gold over here. And the change in the system is what gold is picking up, amongst many other things. All attempts to create more money to solve the dollar standard issue tends to devalue all fiat versus gold. Gold is rallying on debt deflation probabilities, not on inflation or hyperinflation. Remember, during the Great Depression deflationary, gold was the best performing asset. Bitcoin will be part of the equation, but has yet to make any serious move against this backdrop. It is 100%. It is up 100% off of the March lows during the liquidity crisis. Its time will come, though. However, Raul goes on. He says, "My guess is that the next debt deflation signal will come when bonds begin to price in negative interest rates. That day is coming soon. Will it be this week when the FOMC meets?" He goes on to look at 5-year yields. Here you could see them getting close to breaking down, and that will be the signal. This is the portion that you need to be concerned with for those who are equity minded. That will be the signal to sell equities, and the insolvency phase will begin. All right, look at this. This is a chart of the S&P 500, and then we're looking at the 5-year index over here. You could see the 5-year treasuries are ready to break down. You see that on this chart very clearly over here. 5-year yields. All right, look at that versus the S&P. All right, everyone, let's take a look at where we are right now on the S&P. And tonight we are coming into this heavy resistance. Again, we have a lot of things to worry about. We do have FAANG earnings tomorrow, starting with Alphabet, right? We have Facebook. Let's take a look. We have tomorrow, April 28th, we have Alphabet, followed by Amazon, later Facebook, and then we will finally end that with Apple. We already had Netflix earnings. They were better than expected. However, Netflix did not actually appreciate on that. Let's see what happens the rest of the week. This is something obviously to keep a watch on. And the reason I say that is because right now, as we're into strong resistance, the market could just be looking for a catalyst to begin to sell off. It doesn't matter if the earnings are positive or negative. If they're negative, people could say, all right, well, the worst is behind us. From here on in, the earnings quarter over quarter should start improving. That could happen. That could definitely happen. If they're positive, but then people say, well, going forward, a situation looks like growth is going to continue to slow down and the earnings are going to continue to suffer. Maybe that's a catalyst to sell off. We're going to follow what's happening on the charts. The other thing that is really important this Wednesday is the FOMC meeting. The market could also use that as a possible catalyst to sell off over here. If it doesn't sell off, and when we regain this resistance, we're going to flip to a bullish bias and we're going to see what trades are available. Now, let's look intraday what's going on. We already saw what happened today. We're between this now. This is turned support, this level at 28.52. I'm going to go ahead and actually turn that over to green so that we have that marked. Let me flip this over as well. And then we have the resistance right above us at 28.92. Are you looking to sell this resistance? The question often comes up, what time frame do you look at to know whether or not the broken resistance, as over here earlier today, was flipped to support? In foreign exchange, that's easy. It's the 8-hour time frame for me. On the S&P 500, it depends on many different factors. It depends on what the current volatility is, how fast price is moving, what time of day is it. There's no black and white answer. You could see right now price is kind of stalling out over here. I dropped down to a bigger time frame. If you on the 4-hour over here, if you start making a lower lows and reject it over here, is that something that I would be interested in taking? Probably not. It depends where the entry came. If going into London, we were still trading higher but below this resistance over here, and the low of Asia was somewhere around here, 28.76. At that point, that gives me a better than one-to-one risk reward coming into this support over here. That's something that I might be interested in taking. It's a pretty narrow range right over here. I'm not really interested. I don't really foresee too much movement before tomorrow's Alphabet earnings after the close and or Wednesday's FOMC. I kind of like just giving this a little bit more time to get a little bit of clarity. At the same time, if I do see momentum picking up to the downside, if I do see us start selling off, if we get below this support, if we flip that support into resistance, I do like taking a short below 28.52 into 2800. I do like that a lot. That's something that I would be more prone to getting involved in than taking something overnight over here on the S&P. I still, because of what's going on this week and what's going on right now, the market's always forward looking. What is it looking to right now? It's looking to the earnings. And it's also looking at the same time to what's going to happen with the FOMC. You notice that volatility normally slows down before the central bank meeting. That's what my base case is. I could see that we're in this tight little range here. We're into resistance. If we break above, could you see this getting away from me before the FOMC? I don't think so. I don't imagine that's going to happen. I think right now is really important to spend time focusing on the charts, doing your analysis, and practicing that precious gift of patience, because now simply the market is not moving. You could see price is completely stalled. It's not the time to get involved. It's the time to wait, and some things are going to pick up. An opportunity is going to be there. If you're on the sidelines when the opportunity comes, then you're able to take advantage of it. If you get yourself into a position where you start monitoring the market really closely once you're into the position, you are just trading on pure luck. That's not going to work out for you. I hope what I'm sharing with you is giving you some type of foundation to help give you a better understanding of how to look at the market and how to better be prepared to trade it. Right now, this calls for us to continue waiting and watching. I'm not looking to take a breakout above. If we do break out above, let me pull up here because again, we're in a pretty tight narrow range. If we break out above and flip this strong resistance into support, I'm looking to get involved. On a breakout overnight above, I am not doing anything and I'm waiting. On a breakdown of this level, if intraday we flip that into resistance, at that point, there is a trade for me in the next 12 to 24 hours that I'll be interested in taking. That's it for today, everyone. I'll talk to you soon.